Welcome back. This is the start of week 2. We're going over a few things in chapter 2 for this week. Up first, we have the horizontal financial statements model. So in chapter 1 last week, you guys learned about the formal financial statements. So the income statement, the balance sheet, statement of cash flows, and the statement of changes in retained earnings. This week, we'll talk about how we can quickly go through effects on these financial statements in an informal setting. So that's what I'm showing here, the horizontal financial statements model. And this is just going to show them horizontally so that you can get them all on a single sheet of paper. First, you'll always list the balance sheet, go through the changes on the balance sheet first. Next, after this blue line, you'll see this is the income statement. So we'll go through all the changes or effects on the income statement from any transaction. And then lastly, we'll go through the effects on the statement of cash flows. And as you can see, due to limitations, we will not be showing effects on the statement of changes in stockholders' equity. And because this is an informal financial statement, we will be able to use abbreviation. So here you can see on the balance sheet, it says assets equals liabilities with abbreviation plus stockholders' equity. So as we learned in chapter 1, transactions are going to be recorded in different accounts. So here we've shown a few different accounts. We have a cash asset account, supplies asset account. You can see stockholders' equity broken down into common stock and then knowing the impacts of transactions on the different financial statements will help in our business degree. So even if you're not an accounting major, you still need to know how transactions affect the financial statements. So let's work through example 1 to see how transactions affect the horizontal financial statements model. So in example 1, we have AC Service Company being formed on January 1, year 1. And the question wants us to show the effect of each transaction on the financial statements. So letter A, we have AC receiving $90,000 cash from issuing common stock. So the first thing happening in this transaction is there is cash of $90,000 being received. So my first asset, my most liquid asset is cash. And we have an increase of $90,000. And then also the cash is increasing from issuing common stock. So common stock is increasing, and common stock is what type of account on the balance sheet? It is stockholders' equity. So we have common stock also increasing by $90,000. Now let's move on to the income statement. That's a balanced accounting equation on the balance sheet, so we can move to the income statement. Do we think that common stock, the issuance of common stock, is revenue and expense item? It is not, so there's no effect on the income statement. And then for the statement of cash flows, was there cash paid in or cash paid out? Yes, there was an inflow of $90,000 for issuing common stock. And based on what was read and learned in chapter 1, you learned that common stock goes under the financing activity section. So I'm going to put FA for financing activity. Right? Letter B. We have AC Company receiving $300,000 cash by borrowing money from a creditor. So the first thing is cash is increasing by $300,000. It's also positive. Next, the cash is increasing because AC borrowed money from a creditor. What type of account is, or what type of event on the balance sheet is borrowing money from a creditor? It's going to be a liability. It's a note payable. AC is going to be expected to pay this back later. So note payable, is also increasing by $300,000. Now, this note payable and cash receipt are not revenue and expense items, so there's no income statement effect. However, there is an inflow of $300,000 cash. And because AC is borrowing money from a creditor, it's a note payable. This is also a financing activity. Next, we have AC Company paying $250,000 to buy land. So we're going to assume that $250,000 is cash. And it's going out, so that is a negative. And then what's the $250 going out to do? It's buying land. What type of account is land? Land is an asset account on the balance sheet. So land is increasing by $250,000. So we have a positive and a negative on the asset side of the balance sheet. We have a balanced accounting equation. We can move to the income statement. Buying land is not a revenue or expense item. We can move to the statement of cash flows. Did cash go in or out? Yes, cash went out. There's going to be an outflow of $250,000 from the statement of cash flows. And it was to buy a long-term asset, which, as you learned in chapter 1, long-term assets are investing activities. The buying or selling long-term investments or long-term assets are investing activities. Right, letter D, AC Company received $80,000 cash by earning revenue. Right, they received $80,000 cash, so let's do a positive $80,000 under cash. Cash is increasing. And how do they get the cash? They earn revenue. Now, on that, revenue is one specific item. And we talked about it, or I had a video on it, and it is retained earnings, which is stockholders' equity. Revenue has a positive effect on retained earnings, so we have an increase of $80,000 in the retained earnings or revenue. Now let's move to the income statement. $80,000 was revenue, so we'll have an $80,000 increase on the revenue. And then revenue has a positive effect on net income, so we'll show a positive $80,000 in net income column. Lastly, on the statement of cash flows, there was $80,000 cash coming in, so there is an inflow, positive. And this is earning revenue for the company, so it is probably their day-to-day activities because it's what they do to earn revenue. So therefore, it's an operating activity. I'm going to put OA for operating activity. Next, we have AC Company paying $60,000 cash for operating expenses. These can include salaries, utilities, maintenance, and interest. So if they're paying $80,000 or $60,000 cash, there is a negative $60, an outflow of cash. So cash is decreasing. And then operating expenses affect which account on the balance sheet. Similar to revenue, operating expenses affect retained earnings. However, expenses have a negative impact on retained earnings. So we see a negative for operating expenses under retained earnings. Moving to the income statement, there is $60,000 of expenses, and expenses have a negative impact on retained earnings. Lastly, cash went out to pay for these expenses, and these are operating expenses. They're part of the day-to-day cost of business for this company, so this is an operating activity. Letter F, AC Company paid $8,000 cash dividends to its owners. So that means $8,000 of cash is going out. So that's a negative $8,000 on the cash asset account on the balance sheet. And then the $8,000 are paying dividends. And dividends, as we learned last week, affect retained earnings. And similar to operating expenses, they have a negative impact on retained earnings. Moving to the income statement. Dividends is not a revenue or expense item, so no effect on the income statement. And in the statement of cash flows, there is a negative $8,000 or an outflow of $8,000 going out of cash. And dividends, as you should have read and learned in chapter 1, fall under the financing activity section of the statement of cash flows. Right, for the last one, the land that was bought in transaction C had an appraised market value of $95,000 at the end of the year. Should we do anything for this last one? The answer is no, because of the historical cost principle, which we talked about in chapter 1. That says that assets must be recorded on the book at the cost paid, and this land was paid or bought at $280,000. So even though there was a change in market value, we do not change the cost of the land on our accounting books. So let's get our totals. All right, so let's check and see if we have a balance equation and the balance sheet first. So in assets, we have $152,000 in cash and $250,000 in land. So that's $402,000. On the liabilities and stockholders' equity side, we have $300,000 notes payable, $90,000 in common stock, and $12,000 in retained earnings, which is $402,000. The balance sheet accounting equation is in balance. On our income statement, we have $80,000 of revenue. And then there's a minus between revenue and expenses, so minus $60,000 equals $20,000 in income. So we are correct on our income statement. And then we can check our amount of cash to our cash account. $152,000 and $152,000. Yes, we are balanced. We are correct.